Hello everybody, Kyle Custer, your senior analyst here at Seafried and Brew, and thought we'd take a little break from the analytics portion, the bank analytics portion, and get back to some economic things. Obviously after the Jackson Hole speech and some Yellen comments, I'm sure you're all up to speed on what she's saying, but you know, what we have seen in the past historically is that the Fed's projections and predictions haven't always gone accordingly. So, which explains the rate environment we're in currently and have been in for the last 5 or so years. So what we're going to go over today is a few topics that are going to help you look at predicting GDP and obviously the reaction of the Fed. So if we know GDP is going to be looking a lot stronger, you know, we're going to see more hawkish stance from the Fed, maybe even some inflation, hitting that inflation goal that they're seeking. So of course there's the GDP Now. This is a little complicated in how they calculate it, but what I like about GDP Now is they release this table. Now as you get closer to the actual advanced GDP release, the GDP differential gets a little smaller and they're typically more accurate. But right now it's predicting that the next release for GDP, the advanced, will be around a 3.5. I've noticed typically it's a little higher in the beginning and it comes down over time. But over here what you can see is how each major release affects each component of how they calculate this GDP Now factor. And they break it down very similarly to the BEA's calculation of GDP. So for example, we just got the personal income and there's a GDP advanced economic indicators release that comes out as well. And those affected the GDP Now score. I brought it up to 3.5 from 3.4. The personal income numbers were a little better than expected. However, the advanced economic indicator release kind of evened it out a little bit, but you can see like PCE bumped up in that case, and that was a reaction from the personal income release. Of course, we always like to go over these coincidence index and the leading index. They're both saying very similar things. Kind of a slow average growth, not much change there. July ticked up, 3-month coincidences at a 0.78. This came out this week. July is at a 1.53. June was revised to a 1.85 for the leading 6-month. So June we were looking at an estimate of around a 3.6 for the year, 3.7 rather. And July came down a little bit and is at that 153, which would put the annual rate around a 3% growth rate. It's kind of similar to GDP Now. And of course, we like to go over the Fed funds futures, and we always want to see what happened before and after Yellen spoke. And what's neat here is we also have the Brexit. So with the Brexit occurring, you actually had a probability of a cut at an 8%. We don't see that cut anymore, but as of right now, we're looking at a probability of a hike. So it's any hike at all. And we're looking at, right now this is for the September meeting, we're looking at anywhere between to that 50 basis point to 75 basis point level. That's where the probability of the hike is right now. Jumped 12 basis points from after Yellen made it pretty clear that she's a little less dovish right now. And then we're looking at the December meeting here as well. And that's where it really changes a lot. We're looking at a probability of hike now of 60%. And we're actually looking at, we're starting to see, albeit very nominal, we're looking at a 1% chance of rates between 100 basis points and 125 basis points. So, but most of that, of course, is saying that there's a 50% chance that we're going to be in that 0.5 to 0.25 in December. So a couple great charts to look at, and of course this is always fluctuating, so you can check it out daily. I believe the code, if you have Bloomberg, is WIRP. Check it out. But like I said, this is a very volatile indicator. I mean, a few words from Yellen just moves it all over the place. So that's all for this week. Have a great week. Thank you.